Welcome to our deep dive into the hidden cost of foreign accounts and why tax advice often differs from what you expect. First, we will frame the problem of dormant accounts and strict KYC rules. Then, we will compare your practical options, from consolidation to maintaining the account, and we will explore why investing directly from a foreign account is usually inefficient. Next, we will clarify contentious tax issues, including why residency, not the source of income, frequently drives your tax bill. Finally, we will map out an actionable plan to exit or streamline wisely, and we will test your knowledge along the way with quick quizzes. Here is our agenda. First, why accounts go dormant and how KYC creates practical problems. Second, your immediate options. Third, a decision map and cost breakdown. Fourth, how tax residency rules, CRS and FATCA, change the picture. Fifth, a clear action plan and pitfalls to avoid. Along the way, brief quizzes will help reinforce key points. Before we begin, an important disclaimer. This video is for education only. It is not legal, tax, or financial advice. Your facts will determine your outcome. Therefore, consult qualified cross-border tax and financial professionals before taking action. With that clarified, let us proceed to the core issues. Advice often differs because the governing laws and reporting rules change at the border. Banks must follow KYC rules. If you do not maintain valid identification, access can be frozen and your funds labeled dormant. Meanwhile, your home country may tax you on worldwide income based on residency. Add CRS and FATCA reporting, and the compliance burden grows. These moving pieces explain why professionals can deliver very different recommendations depending on your residency, domicile, and account jurisdiction. Let us clarify dormancy. Dormancy is usually triggered when a bank's KYC requirements are not met. If your ID or address is outdated, or your passport has expired, the bank may restrict access. While the account sits dormant, maintenance fees may continue, and currency risk persists. Reactivating is not immediate. It can involve collecting documents, notarization or apostille, and sometimes in-person verification. In short, a dormant account becomes a cost center rather than a convenience. With that in mind, we can now examine your options. Here is a side-by-side comparison. Consolidating funds to your home account simplifies oversight, reduces foreign maintenance fees, and typically lowers reporting complexity. Yes, you may incur a wire transfer fee and face currency conversion risk. But for moderate, unused balances, this is often offset by the long-term simplicity and reduced admin. On the other hand, investing directly from a foreign account can be administratively heavy. You may need a cross-border brokerage relationship, and you will likely trigger additional reporting such as CRS or FATCA that increases professional fees and complicates your compliance profile. Therefore, for many individuals, the regulatory hassle outweighs the marginal benefit of investing in that jurisdiction. This flowchart guides your decision. Start by asking whether you need access to the money soon. If you do, consolidation is the straightforward route, acknowledging the wire and currency costs. If you do not need funds immediately, check whether the account is dormant or fee-heavy. If yes, consolidation still typically makes sense to limit ongoing erosion. If the account is neither dormant nor costly, consider whether you truly need funds parked in that jurisdiction for a specific purpose, like recurring local expenses. If that is not necessary, consolidation remains the default. Meanwhile, if you consider investing from the foreign account, expect complex brokerage arrangements, increased reporting obligations under CRS and FATCA, and higher professional fees. That path is rarely efficient relative to consolidation. Consolidation wins in most moderate, unused, untiresome scenarios. It reduces long-run costs because you maintain fewer accounts and encounter fewer maintenance fees. It also simplifies reporting, which lowers the risk of errors or omissions. Additionally, it reduces the risk of missing KYC updates and returning to dormancy. While currency timing is a real risk, you can manage it using staged transfers, limit orders, or forward contracts where available. Taken together, consolidation typically offers the best risk-adjusted outcome. Here is a safe consolidation workflow. First, confirm your residency and tax status before moving money. Second, request the full fee schedule and the actual foreign exchange spread from both sending and receiving banks. Third, ask your tax advisor whether the repatriation could create a taxable currency gain. Fourth, review required forms such as CRS or FATCA, self-certifications, and any source of funds documentation. Fifth, consider staged transfers to manage foreign exchange volatility.
Sixth, document the entire transfer trail for audit readiness.
Finally, close or downgrade the foreign account once the funds are moved to eliminate continuing fees. Quiz time. The question asks, for idle funds incurring fees in a foreign account, which path is typically most prudent? Option A, keep the account and ignore fees. Option B, invest directly from the foreign account. Option C, consolidate and transfer to your home account. Option D, move funds between multiple foreign accounts. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is C, consolidate and transfer to your home account. This approach usually reduces long-term costs, simplifies reporting, and avoids the recurring KYC maintenance that often triggers dormancy. Let us quantify typical costs. Wire fees are the basic outgoing transfer charge. The foreign exchange spread is the hidden margin over the interbank rate, often the biggest line item. Correspondent banks may deduct their own fees. Compliance reviews, whether by your bank or advisor, vary widely.
Finally, annual maintenance fees continue if you keep the foreign account open. These ranges are indicative, can vary by institution and jurisdiction, and should be confirmed with your providers. Investing directly from a foreign account usually underdelivers. Cross-border brokerage onboarding can be slow and complex. Reporting under CRS and FATCA adds ongoing paperwork and professional fees. Jurisdictional frictions, such as withholding taxes, market access limits, and differing investor protections, can diminish net returns. Absent a compelling local need, the administrative burden rarely justifies this path. This pie chart illustrates a common distribution of costs. The foreign exchange spread often dominates the total at around half. Wire and correspondent bank fees collectively can be a fifth. Advisor or compliance costs consume another fifth, and miscellaneous items fill the remainder. Your personal mix will vary, but the message is consistent. Do not underestimate the FX spread when planning a transfer. Now we turn to tax. Many are surprised to owe tax in their home country based on residency, even if the income arose in a zero-tax nation. It is residency, and sometimes domicile, that determine your worldwide tax exposure, not merely where the money was earned. If past advice seems inconsistent, consult a specialist in international tax to reassess your filings and potential remedies. Understanding residency, treaty positions, and filing obligations under CRS and FATCA is crucial before moving funds. This timeline shows the pre-transfer tax checks. First, confirm your residency status. Second, identify potential taxable events, such as currency gains or accrued interest. Third, review your CRS and FATCA obligations. Fourth, obtain written advice tailored to your facts. Fifth, execute the transfer with your chosen FX strategy. Sixth, archive banking and advisory documentation for future reference and potential audits.
Our second quiz asks, which factor primarily determines your worldwide tax liability in many systems? Option A is where the money was earned. Option B is your bank's nationality. Option C is your tax residency and domicile. Option D is whether your account is dormant.
You may pause the video now to consider your answer.
We will discuss it in the next section.
The correct answer is C, your tax residency and domicile.
In many systems, these determine your worldwide tax liability. Source rules and treaties can modify outcomes, but residency and domicile are the foundation. Let us distill key tips. For idle balances that incur fees, closure and transfer is usually best. Always secure cross-border tax advice before moving funds to avoid unexpected taxable currency gains. Document your KYC updates, advisory opinions, wire confirmations, and the FX rates used. Use staged transfers or hedging techniques to manage currency risk. If you must keep a foreign account, maintain immaculate KYC to avoid dormancy. Here is a quick reference in checklist form. Confirm residency status. Request fee and foreign exchange quotes in writing. Ask explicitly about the potential taxation of currency gains. Prepare any CRS or FATCA forms in advance. Plan staged transfers if that better manages your currency risk. Watch for red flags such as dormant status with ongoing fees, unclear foreign exchange spreads, and a missing documentation trail. A practical tip is to ask your bank for the exact FX rate formula and to disclose any correspondent bank deductions up front. To conclude, strict KYC rules often create dormancy, turning convenience into cost. For moderate, unused funds, consolidation typically outperforms investing from abroad. Remember that residency and domiciles often control your worldwide tax position more than the place where income arose. Plan transfers deliberately, manage currency risk, and avoid surprise tax events. If you must keep a foreign account, maintain perfect KYC and documentation. Thank you for watching. If you found this helpful, please like the video, share it with someone who might benefit, and subscribe for more cross-border money clarity. Share your questions and experiences in the comments so we can learn together.